Netflix reported quarterly financial results after the stock markets closed on Tuesday, October 21st, 2025. Those results are sending the stock price down by more than 5% in the aftermarket hours following this earnings release. Hopefully, you watched my Netflix earnings preview, and in that video, I informed investors that I didn't think it was a good idea to buy Netflix stock heading into earnings. So now that the company announced those results and the price is down more than 5%, is the stock a buy now? So I'll review the numbers and I'll highlight the factor that's sending the stock price lower. And then I'll update you on what I think about Netflix stock, whether it's buy, hold, or sell right now. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. Right, so Netflix revenue in Q3 came in at 17%, in line with what the management team was forecasting. However, the operating profit margin at 28% was lower than what management was forecasting. Management informed investors that they thought the operating margin would come in at 31.5%. And I was talking about how if they did indeed hit that target of 31.5%, that they might actually increase their operating margin forecast for the full year. Well, it was a double dose of bad news. Not only did Netflix not hit the target that they were forecasting for this quarter, they actually lowered their full year 2025 target. The opposite of what I was expecting. I was expecting perhaps an increase to the full year target. The reason for this underperformance is related to an expense with an ongoing dispute with Brazilian tax authorities that was not in our forecast. So this is a cost that Netflix was not expecting to incur, but now they will incur this cost. And as a result of this increase in cost, their operating profit margins are to decline because Netflix will incorporate this cost in their cost of goods sold, which is a little bit strange because typically tax goes below your operating margin, right? You have your revenue minus your cost of goods sold, minus your operating expenses, which include like sales, general, administrative, research and development, etc. And then you have your operating income. And then below your operating income, you have your interest expense and you have your tax expense. But in this case, Netflix is accounting for this tax, what appears to be a tax in its cost of goods sold. So I need to look more into the details of that. For investors, it's not a big difference whether the cost goes in their cost of goods sold or if it goes into their tax. The company will account for this, and this is an issue, like a one-time issue, not a recurring issue for Netflix moving forward. So the Canelo Alvarez versus Crawford boxing match, which I watched, it became the most viewed men's championship fight this century. And that just highlights the scale of Netflix's reach. Over 200 million subscribers, over 230 million subscribers the last time we got the update, and likely more now. But that reach allows Netflix to have these kinds of events reach this kind of scale. And this is a new thing for Netflix. For many years, Netflix wasn't going into sports because the content cost, it cost a lot for the sports rights. If you've been following some of the deals that the NBA and the NFL have been signing with some of their partners, you'll realize these are multi-billion-dollar deals, and Netflix didn't want to go down that route and pay so much for sports content. But uh, on a case-by-case basis, they have been bidding for some sports content, and so far they've achieved great success in that arena. So I mentioned that if they hit this revenue target in the preview video, that it would be 2 consecutive quarters of accelerating revenue growth, up from 12.5% to 15.9 in Q2 to 17.2 in Q3. That's really strong, but the forecast for Q4, Netflix is forecasting 16.7% growth. That would break this small streak of 2 consecutive quarters of accelerating growth, but still year-over-year growth of 16.7%, really strong from Netflix. And then the operating margin came in well below what they were forecasting at 28.2%. And then the forecast for Q4 25, yeah, 23.9%. If they hit that target, it'll still be above the 22.2% they hit in Q4. So structurally speaking, Netflix remains on target, remains on track, remains the best streaming provider. This tax issue, one-time issue with the Brazilian tax authorities, doesn't undermine the long-term prospects of the company. So they elaborate a little bit on this. The cumulative impact of this expense, approximately 20% of which is for the year 2025, with the remainder related to periods 2022 to 2024, reduced their Q3 margin by more than 5 percentage points. Without that expense, they would have exceeded their Q3 operating margin forecast, and they don't expect this matter to have a material impact on the results in the future. So it turns out that things were going much better than what Netflix was expecting, and I think they would have raised their operating margin forecast like I was forecasting. They would have increased their forecast for 2025 on their operating margin, but as a result of their expense, they're actually lowering that forecast. So here's that update. They're now forecasting a 2025 margin of 29% compared to their prior expectations for a 30% margin. And that's due to the impact of the Brazilian tax matter. So they were on pace, well ahead of their operating profit margin for the year. And then this situation happened and they downgraded their expectations for profitability by 1 percentage point. Not a big deal, but it's just, I know many investors like myself were expecting an increase of their operating margin forecast for the year. So it's kind of like a double whammy. We were expecting an increase of the margin forecast for the year, and instead we got a decrease. So that's what makes it a little more worse than what we were expecting. And I think that's the primary reason why the stock price is down by more than 5 percentage points in the aftermarket hours. That being said, longer term, the structural factors that are keeping Netflix dominating the streaming industry remain and even got stronger in the quarter as the company demonstrated some really strong results. Demon Hunters, the most popular movie ever on Netflix. If you have kids, you probably know about that movie. The songs are probably in your head. And then the Canelo versus Crawford fight, huge success. So Netflix dominating, now demonstrating its dominance there and providing an opportunity to expand into sports more opportunistically. So to update my recommendation, I will keep Netflix stock rated as a buy after evaluating those results. And here's an example of why, surrounding earnings events, sometimes it's better to wait for the earnings to come out, digest the figures, and then make your allocation, especially when you had a company that was trading at a relatively expensive valuation going into the earnings release.
Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.